welcome to another webinar from Baselane. My name is Saad Dar. I'll be your host today. I want to introduce our guests in a second. The topic for discussion is choosing the right loans for your investments. So thank you so much for joining. Just some housekeeping. This is being recorded and we will share this with you afterwards, and we'll be posting it on our Baselane YouTube channel as well. And without further ado, I wanted to introduce our guests. We have Ryan and Jonathan from Simplist team. Simplist is Baselane's preferred lending partner. So we're very, very excited to have them here to just tell us more about Simplist, talk to us more about lending in general, and answer some of your questions. So I'll hand it over to Ryan to maybe say a quick hello, and then we'll go to Jonathan.
Thanks, Saad. So I'm Ryan McPartland. I've been in the mortgage industry for close to 24 years now. I've held several roles within credit risk, origination, fraud prevention. I've had my own mortgage brokerage shop and been around the block. I'm working for Morgan Stanley, UBS, Credit Suisse, JP, all the big banks, all the big private banks. So I've had a lot of exposure to a lot of different opportunities that are that clients come to me for. Not only just the simple vanilla loans, but things that get a little more complex. Finding those solutions is really what I do best. So I partnered recently with Simplist because they have exceptional, their technology is great. They have their process is unbelievable, and they have a great group of people working behind us, Jonathan and myself, that actually facilitate these transactions to really make it a great transaction for the borrower. And I'm totally happy with coming back to Simplist. So we're excited to talk to you guys today.
Awesome. Jonathan, do you want to say hi?
Yeah, I think Ryan said a good overview about how we operate. My name's Jonathan Scott. I've been in the mortgage space generally for about 8 years. Started on a mortgage-backed security desk for about 3 years, learning the soup and nuts, and have been more on the origination side since, and have been the better part of that journey with Simplist. And to reiterate what Ryan said, really a cool blend of a good offering from a product perspective and technology and a good team. So we're excited to tell everyone a little bit more about that and how that's making our clients' lives a lot easier.
Awesome, and we're super excited to have you. So just for everybody, these are some high-level ideas that I thought about, and we talked a little bit about talking to you about different topics. So we'll talk a little bit about different ways you can fund rental property deals. We'll talk about what are the ways you can get approved and improving your success with that. Maybe I think we'll also touch on through the discussion the different types of vehicles you have, whether it's conforming or non-conforming, through that as well. Just for our video audience before we get started here. So what is Baselane? So if you're learning about Baselane for the first time, you've never heard about us, and you're wondering what the heck is Baselane? So let me tell you a little bit about Baselane for a few seconds here. So Baselane is banking built for landlords and real estate investors of all kinds. We have an all-in-one platform that not only provides you with a business checking account, but also provides you with a online rent collection and tenant management tool. In addition to that, we have our own bookkeeping and reporting software. On top of all that, we have a lot of other really cool resources like free analytics and rental property calculators on the platform. So if you have not heard about Baselane and you'd like to learn more, go ahead and check us out. That's just a quick preview for anybody that is new to Baselane. And with that, we're going to launch our poll here, and Jake, if you can help me out with the analysis. So if you can, everybody who's on here, please go ahead and answer some of the questions for us. This will really help me and also our host, our guest here, just understand a little bit better about you. So a couple of questions here. How many rental properties do you currently own? What type of rentals are in your portfolio? And what kind of loan financing are you looking for? And so we've got some options there. And you can also, there's a free field for I need another type of loan if you want to, just let us know something else that's on top of mind for you, or you have something specific that you're looking to do. Awesome. So that's coming in. We'll give it a second. And, just a little bit of background, I guess, with Baselane and the Simplist team. I think we've been working together for, almost a year now. We started sometime last year, and we've been excited to work with Simplist just because of the technology platform that Simplist has and the amazing experience that customers have through not only the service and talking to the experts at Simplist, but also obviously the speed with which you can get, access to the money that you need to do your deals. And I'd love to talk a little bit about that. So here we go. We've got the poll here. So let's see. It looks like about a third of the audience here has about 2 properties. There are about 20% have 3, 14% have 4 to 10, and about 15% have more than 11. So just to give you guys a little bit of a idea of who we're speaking to at the moment. What types of rentals are in your portfolio? So 91% said either long-term, midterm, or long-term. Majority usually is the long term. About a third of them have short term, which is Airbnb or VRBO type properties. 8% have fix and flip, and 42% they have owner occupied multifamily where the landlord might be living in the property and they have tenants in other units. What kind of loan financing are you looking for? 54% are saying DSCR, 50% are saying conventional. So that's really interesting. We'll talk a little bit about that because I think depending on your situation and who you are, you definitely can access conventional to get started. For example, 36% are saying new construction loans. And I think we can talk about that. I think we've been working with Simplist to bring some of that into the fold in terms of the products that we offer. And 43% said they're not sure, which is actually, you're in the right place if you're not sure, because we'll definitely talk a little bit more about that. Yeah, I think with that, let's get started. So maybe, I don't know if Ryan or Jonathan, one of you guys can tell us a little bit more, just kind of a 1 to 2 minute story about Simplist, just to familiarize the audience with what is Simplist and what do you do?
Yeah, definitely. I could get this kick started here. So Simplist is definitely a technology-driven mortgage marketplace. We've been lending pretty seriously for the better part of about 7 or 8 years, and it really was about creating a not painful experience. And I think a lot of that was just leveraging technology the right way, and starting off with very simple mechanisms to put in your information, and has gone as far as direct API integrations with some of the biggest, wholesale lending partners in the industry. So I think, that's to give an idea of how we're thinking constantly about technology and using it in the right way. And it's about choice. And I think, the notion of visibility, right? So partnering with, a variety of lenders for, different use cases. And I think, we'll spend a little time talking about conventional versus non-traditional, but I think it's a good way to think about Simplist out of the box.
Yeah, and one of the things I love about Simplist, and I know a lot of people get worried about this, is if they sign up for some sort of online form, they're getting like 15 calls within like 5 minutes from random companies trying to get their attention. Can you talk a little bit about why you don't do that, or like how is it that you're not able to do that, and what is your approach to just helping people find the right lender and the right lending options?
Sure. I think fundamentally, I tell clients all the time, there's a lot of common sense that goes into the operating model with Simplist, and thinking about what we would want, right? So up front, we only do soft credit checks, which is really important. Obviously, there are use cases where a hard inquiry will be needed, but we're very clear about when that's going to be, and that's typically what triggers the avalanche, quote to say, because there are some practices in this country that hopefully will be outlawed soon, but the credit providers have the ability to sell credit information, which is really not ideal, but that's a good example of a pretty decent common sense practice we put into place to at least start out of the gate. So the soft credit checks really insulate and let us focus on our conversations first without everything else coming as a distraction.
Yeah, just expand on that just a little bit. So how that works is that they're trigger leads. So basically when you get your credit pulled, the bureaus are now selling your data to other originators, other lenders, other banks, because they identify that this is now a lead, we'll call it, and it just disperses out everywhere. So again, like Jonathan's saying, soft pull, we really insulate the transaction to kind of touch back on the not a large number of calls and so on. It's you and only you. It's Simplist and only it's you and Simplist, and that's it. We're not selling the information. We're not sending it somewhere else and having someone call you. We drive the entire process. So when you meet someone like Jonathan or myself and you start working with us, you're going to work with us from the start to the finish, and there's not going to be anybody going, "Hey, do you want to have you need some other financing? Hey, do you need this? Your phone's not going to ring. You're not going to get junk mail, etc." So that's how we work. We like to keep it in-house and in-house only. So most people find that to be obviously a much better experience, because those calls can definitely get quite annoying, but we avoid that.
Absolutely. Yeah, and I can relate to that too, and that's part of why we partner with Simplist, and I love that about it. It is hassle-free. When we say hassle-free, that's what it means, folks. Like, your data is not getting sold to anybody. You're opting in to have a conversation or get some pricing for a specific deal. And maybe if we have time, we can kind of go to the website at the end and kind of show folks around. But I guess to get started with the topics related to the lending, as we saw, there are different types of folks that are here, and there are different levels of interest that they have in terms of the types of loans that they're looking for. And I think from the poll we saw that some are owner occupied, some are looking for conventional, versus some are looking for DSCR types loans, and some are looking for fix and flip. So maybe we'll start with the rental category first, and we'll talk about the fix and flip after. So within the rental category itself, for somebody that has a couple of properties and is looking to add more, what are some of the typical vehicles available to them to get financing for their next project, for example?
Yeah, so I think starting about I think 2 basic categories, and I think with intent, I'll kind of handle one piece and Ryan the other, because he's been You've seen everything there is to see in terms of creative financing. So obviously there's conventional or traditional and, unconventional or untraditional financing. And I think from a conventional standpoint, we have the ability to access, super competitive terms and, some of the basics regarding, down payment is going to be a little bit lower, 15% on one unit investment properties. It's a little bit higher on multi-unit, assuming it's non-owner occupied. And that's going to be your traditional loans qualifying with income and, other underwriting criteria. Definitely a little bit stricter per se in terms of qualifying, but the rates are going to be more competitive. Your closing costs will probably be a little bit lower, and I would say, a good vehicle for someone looking to start, maybe those intro investors. And then I think there's the non-traditional financing that I think Ryan can shed a lot of light on as well.
Yeah, I mean, along the lines with Jonathan saying, it's conventional financing, I wouldn't say is only limited to first-time investors, to make sure that that's clear.
Yeah.
I think that most people know or understand generally how mortgage financing works, who's looking to buy a house. And those are those typical loans like Jonathan was talking about, where you qualify based on your income, your assets, and your personal credit score. Think of it this way. There's two types of borrowers. You have the natural person, which would be an individual like us just buying a house in our name, or you have it owned by or financed as an entity. Okay, so with the loans that Jonathan had mentioned, the conventional, you hear Fannie Mae, Freddie Mac, FHA. There's certain criteria that has to be met for each one of those from an underwriting perspective. There's limitations on this and limitations on that. And again, that's where people like us would come in, right? We give you the direction. So come to us first. I can't hit home enough that the preparation in this transaction is so paramount to success from a closing perspective. So kind of moving on past the standard conventional transactions, DSCR is obviously a hot topic. So basically you're taking the gross rent. Let me take a step back. Lenders won't be looking at your personal finances. They will consider your credit score, so keep that in mind. But they won't ask you for any employment information, personal assets, most times. Sometimes they ask for a PFS, a personal financial statement. But sometimes they do, most times they don't. But they'll look more toward, what does the collateral look like? What is the cash flow on the collateral? We're going to look at the risk profile of the property, not necessarily of the payee or the person making these payments, which is typically the borrower, which is you as an individual. So you can do these DSCR loans as a borrower, as a natural person, or you could do the loans in a business name. We'll talk about that in a minute. But how the DSCR works is, instead of qualifying on income, the lenders will look at the debt service coverage ratio, DSCR. They'll look at the gross rent divided by the total debt service of the loan. Okay, and debt service would be principal, interest, taxes, insurance.
Insurance,
if there's homeowners association dues, they are considered as well. There could always be, I don't know, there's never, but if there was mortgage insurance involved, which is not going to be on these loans, but all of that's considered. And the idea here is they're looking at that ratio. If the ratio is 1% or higher, it's typically a lower risk. I never use the word slam dunk, but it's a good deal. There's a lot of options in that category. And that would be, imagine if the rent was $4,000 and the debt service was, say, $4,000 or like $3,900, somewhere right around 1% is really what a lot of lenders look for. You jump up to 1.25, and it's even better. And as the debt rate, the debt service coverage ratio goes up, risk goes down, and the rates would also go down as well, because rates move with risk, right? Now, there are options where DSCR, if that ratio is not hitting 1%, let's say it's at 0.7 or 0.8%, again, that's risk going up, and the rates would follow up with the risk. Okay, because think of it this way: if the gross rent was $3,000, but the debt service was $5,000, there's obviously that $2,000
more risk.
Yeah, there's more risk, right? Where's that other $2,000
Yeah.
coming from? So that's all considered when the underwriters review this information. So with that risk comes a higher rate and so on. But a lot of these lenders are willing to take some risk on these deals because you're putting 25% down, 20% down in some cases. And there are even some opportunities to go higher from a leverage standpoint as well.
Yeah.
We would have to start looking around and look at the property. Now, I think something that's really key here as a takeaway is, well, how do I know what the rent is? Right. I found this property, does it work? So
Right.
you need to consider a lot of different pieces at this stage. You'd want to say, how much is the rent? Who's telling me what the rent is, which I'll tell you in a second, but start at like rent.com or AirDNA for like short-term Airbnb rental information. And yes, you can qualify for DSCR with
Yep.
short-term
And
rental.
And Baselane has got a free calculator for pricing your rental. So you can go on Baselane's website.
Oh,
It's free.
yeah,
You don't have to log in or
perfect.
anything. And you can just type in the address and it'll answer some questions about the number
Even
of
better.
units and all that. It'll give you a median, a high, and a low rent estimate for that address.
That's awesome. So we all know now where we're going to go. And I think that a key here is when you get the loan. So dissimilar to a standard mortgage transaction, in the conventional space, the loan application doesn't include personal income, personal assets, personal employment, and so on, like we discussed. The thing that matters is, well, how much is this rent and how's it determined? So the appraiser goes out to the property and does a rental schedule and says, here what the surrounding rents are coming in at. And that ultimately ends up being that numerator of that equation, saying, here's the rent
Right.
that's determined by the appraiser. A lot of people have that question. So what's the number? And sometimes when we talk about this with our clients, it's like, well, I think it's 2,500 a month. Well, I'm seeing $3,000. And that's the tough part with these loans, right? That you don't know exactly what the rent's going to be. So you have to have somebody like us has multiple options for financing, right? Because if we can't do it here, we have 5 other people that will do it at a different ratio. And that's
Yeah,
really
that's
important.
helpful. I want to take a quick step back. I want to maybe, since we did the overview of conforming and non-conforming, going a little bit deeper on the conforming side. You made a really good point. I wanted to just understand that better. So you mentioned conforming is not just for a new investor, right? So how should people be thinking about conforming loans, which are the conventional, traditional loans, basically like a regular mortgage? And what are like the situations in which it makes sense for people? Maybe we can talk a little bit about that.
Yeah, I think there's a few things to consider. I think I can add some commentary, and so can Ryan. But I think in a lot of ways, if there is more willingness to put a loan in an individual's name, right, or they think about that risk reward, yeah, I'd rather pick up, some more, lower payment with a lower rate because I'm going to put that in my personal name with conventional financing. That is one, consideration for sure. And also sounds kind of funny, but it's true. Like for the part-time investors that have traditional income, W-2 job, a lot of boring aspects to their file, boring in a good way here. That is going to be key. Someone with 4 different businesses and 7 different rental properties and 6 in LLC. Sounds like that person has got it going on, but that probably won't be the best fit. So I think that conversation with someone like me or Ryan is going to help really determine that pretty easily. But
that's a really good point. Yeah, I'll ask a basic question because I think people do get confused about this, and just sometimes you don't know, like, when should we start having this conversation, right? Like, what's the right time? And we talked about this last time we had a lending webinar as well. When people is it when I'm starting to say, okay, I saved enough money, I want to start looking for my next deal? Is it at that point, or is it at the point I've got it under contract and it's like, okay, like I gotta fund this thing, so I'm gonna go talk to somebody. What do you guys recommend? Where do you see the most success?
Look, I'll take this one. So this if I could broadcast just this exact question to the world, I'd be the happiest guy ever because I wish everybody understood this. It should be obvious. Preparation is key here, right? You want to, if you even are thinking about looking at financing options or buying a new home, buying an investment property, you really want to get your ducks in a row because everything isn't perfect. If everything isn't perfect right now, we could say, all right, here's what we need to do over the next X number of weeks or months or whatever to prepare you for the best approach from an underwriting or credit risk review standpoint, right? And getting the more information, the more conversation we have, the more information that gets uncovered just makes the process ultimately easier. And, in the end, it could end up getting you a better rate because the preparation was done. Hey, I have this thing on my credit. There's a little bit of a black mark on my credit. Let's fix it. We can help you fix that as well. We can get credit updated and
That's
so on.
great.
All matters.
That's awesome. Yeah. And I think I just want to reiterate this again to spell it out a little bit. It's because I think sometimes we wait too long. Like, I think there's so many different scenarios here that we really can't even cover in hours of conversation. So basically the point is have the conversation with the Simplist team, get pre-qualified, share your personal information, share your plan, talk a little bit about what kind of property you want to get, see if that works, what kind of loans you can get, right? All of those things I think need to be discussed. So for me, actually, when I go to market, it's easier because then when I'm making offers, I'm more confident, right? Because Now I'm making an offer. I know I can fund that deal at whatever X% loan to value, and I know that the Simplist team will move quickly on it. So that's super helpful. There was somebody that had mentioned a couple of people here that are owner occupied type investors. What are, maybe just a minute or two on this one, what are some of the options there if you are maybe just first deal or second deal, and let's say you have a 3-unit or 4-unit and you live in one of them and you want to rent out the other 3? Is that more conforming? Is that DSCR? What are the different options?
Conforming all day long.
Yeah.
I would say an advantage that we haven't spoken of that is thought of as really lower down payments to get in these conventional loans. Okay, so that's a big key. You can get in for 3.5% on an FHA multifamily. That's a big deal. You could get it, live in one of them. So getting directly to your, it's a great way to start the investment scenario, where if you're living there and for some reason you don't get the rent, or excuse me, multiple renters can actually help pay your mortgage payment. If one falls off, it's a little easier to cover than, say, another rental property where you're not watching it. You live there, you can see the property, you can watch what's going on until you really learn how to, become a landlord, an investor. There's a lot more to it than just getting financed. You got to, cameras if you're doing that. You have to clean up the space. Renters are pains. It's not an easy thing to get into, but if you do, it's very lucrative. So there's more to it than just this financing side of it.
Yeah, absolutely.
And I think
There's
just
a
to add
question.
one more point, sorry to
Yeah,
cut you off, but really cool improvement as of late. Ryan made a great point. FHA is the lowest down payment, but Fannie Mae recently rolled out a really cool change to their guidelines. Multi-units used to be 25% to get in the door, but now conventional we can get in with 5%. So that's been I'm doing this a fairly long time, not as long as Ryan, but that's a cool change.
Big time.
So just to make this real, you're saying 5%. So if we're talking about a $200,000 property that's multi-unit, owner occupied, you need basically 10 grand to get in.
Yeah, plus closing costs.
Plus closing costs, but yes.
Okay, awesome. Yeah, that's a huge one. I don't know if people know about this yet, but I know, Jonathan, we talked about this a few months ago. We actually sent more leads to you for that because people were getting very excited about that. So that's a huge one if people are looking for, a way to get in with lower down payments. I want to encourage everybody to start sending questions. There are 2 questions already here, and we'll continue the conversation. One is about Simplist. Does Simplist offer products all over the country? Maybe you guys can just cover that really quickly in terms of the just number of states. I think that information is on the landing page, by the way, as well, and we'll send you the link. But do you guys want to just maybe talk a little bit about that?
We do have, there's 2, you got to bifurcate this slightly. So for conventional financing, we're in several states. It's on the webpage.
We'll send the link out afterwards.
We'll make sure that everybody knows exactly where we're licensed. However, for DSCR loans, considering they're business purpose loans, we don't have to be NMLS licensed, which is different than the regular conforming type transactions. So it creates a very wide coverage for us. There's only a couple of states we can't write DSCR loans in. So basically, generally speaking, we have national coverage for DSCR loans in a very high number of states for conventional financing.
That's great. We touched on closing costs a little bit earlier just now, and one of the questions from before was, why do closing costs vary so much when I compare mortgages from different lenders, in parentheses, irrespective of the buying points?
John, you want to take this one?
Sure. I think
it's crazy to me, but yeah.
Well, I think it's twofold, and I think I appreciate whoever that audience member is, mentioning points. So I think there is different financing partners are going to have an appetite for certain scenarios better in more scenarios than others, right? So I think knowing where to place these loans is a big part of it. I'd say 50%, and the other 50% is who are you working with, right? Simplist operates at the wholesale level and stays very competitive in that sense in terms of who we partner with. We don't partner with everyone. We actually turn a lot of partners away because they're not competitive. So even though they may have one detail, that's okay. For lack of better words, they can keep it. Our job is to keep our options, extremely competitive for our clients. So I think it's about how we're set up to as an avenue or a vehicle.
Yeah. And basically, I I don't know if Ryan, if you want to add to that before I speak to the next one.
Just you should typically see when there's a huge variance in costs, that's a big red flag. There's only so much in costs that are typical to a transaction, right? And the key to
Right.
shopping loans, just to make this clear to the audience, is you want to look at the lender fees. Okay, one lender might say $2,000, the other might say $2,000, but someone might say there's 30 days of interim interest. They might be funding 10 months of escrow, which artificially inflates the total closing costs. So you have to be
Right.
mindful of that. Other than the lender fees, everything else is going to be a constant regardless of who you go to. So, make sure that that's viewed, because a lot of times
Right,
people
like the title, closing costs, title insurance, and those kinds of
right.
things.
That's all
Yeah.
estimated at the time of the initial conversation. We don't know, or anybody else doesn't know, what the title fees are going to be. So theirs might be lower than ours. They might put 1 day of interest and no escrows. We might have said, here's the title fees that we use, and there's 10 months of escrow, which is right. We're not, a lot of people
Right.
make it look like the closing costs are lower. So you have to be mindful of what line items to be looking at to make good comparisons between loan estimates.
That's a great
That's
point.
helpful. That's very helpful. I want to talk a little bit about just being successful in the loan approval process. And this is really important because, we get this question a lot, like, am I qualified? Like, how much money do I need to buy X? This question comes up all the time. It's really hard to answer this question because everybody has a unique situation. And I'd love to get your input on, one, what are some of the guiding principles of, the things you'd have to be a good borrower, right, candidate? And then what do you recommend people do to kind of like be successful with that, basically?
Sean,
So,
I mean, start.
yeah,
All
I
right.
mean,
So
go ahead.
from a overall credit risk perspective, the best way to really get yourself prepared is to, take a look at your credit score first and foremost, because FICO score drives a lot of the credit risk, whether we want it to or not. We're held captive by these credit bureaus like TransUnion, Equifax, and Experian. So we'll look at all three. We give you the benefit of the doubt, as most lenders do, and look at the middle of the three, because each one of the bureaus reports something slightly different. So you want to make sure that you're not, before you go to get financing, you don't want to run up your credit cards, increase the balance to limit ratios. You don't want to open any new credit cards, because when you have inquiries on your credit report, and this is a big thing for everybody, don't pull my credit. Pull your credit, it's not going to change your credit score. As long as you're not shopping for credit cards, installment debt, student loans, and then looking for a mortgage. That's a huge red flag. That's when the credit score will drop due to an inquiry. If you're looking at if we're pulling your credit to look at it for mortgage financing and you're not pulling it for other reasons, your score shouldn't drop.
Right.
That's a sales tactic that's been going on for years, saying this will prevent people from shopping.
Scares you, yeah. Shopping should not affect your rate.
Right. Everybody, I'm telling you, after 20 some odd years of doing this, I'm telling you, it's not going to make a difference. And another key thing to know is your credit score that you see on myfico.com or Credit Karma doesn't necessarily match what we pull. It's not some big game that we're playing. It's just the fact. It makes no sense. But just know that if you see 740 and I tell you it's 735, whatever we pull through a residential mortgage credit report is what the lender is going to use to close. Right?
Yeah. I've got a couple of specific questions here, so I'll ask. So in terms of the credit score itself, is there, I know it might vary depending on the loan product, but is there an absolute minimum that people have to be above? And what's your ideal, like, what do you prefer? Is it like you need to be in the 680 plus range, or, are lower thresholds available? Are there options for people with 650 and so on?
John, you want to take that? I'm going to hit it too.
I mean, I think a lot of this is, just both offering good perspectives here. I think, I think as a rule of thumb, mid sixes and up is a good standpoint. But I think what we have done a good job of and continue to do is for the most part, there is a home for every scenario, right?
Right.
Let us figure that out, right? Give us the harder use cases. We'll find it. I don't like this stuff too. We're really lucky, right? We really like mortgage. So, it's hard and fun for us too.
Okay, that's helpful. And should people, people always ask like, hey, how much do I need to do X? Do I need 20K? Do I need 15K? Do I need 60K? Right? It sounds to me like they're always talking about the improving financial stability equation part of this to get the loan. So, any thoughts on that? Like, how should people be thinking about that? I guess it does, based on what you said, it does depend on what type of loan is we're kind of like in play here. Is it a DSCR versus a conventional loan. But like generally, should we be saying, okay, I need to improve my financial stability if I'm going to get the, a certain type of loan? Should I be saving up a certain number of funds, etc.?
Yeah, I mean, I think that, like, again, with DSCR, it's really not based on personal finance, right? So you
Okay.
have to table that. That's off the it's either you have to have a good credit score, good, 620, you could still get in.
Okay.
I never like to put caps on anything because there's always some
Right.
interest somewhere. So don't
So
don't
that's more about the deal and the cash flow and the
Yeah.
rents.
100%. It's
It's the collateral and what the debt or what the gross rental versus the debt services, period. So that's tabled. So you go only to the conventional side. Yes, planning ahead, like don't switch jobs. I had people quit their jobs 3 days before closing, just like mind blowing, right? But people don't have the direction, right? They don't know any better. So knowing this is actually obviously becomes helpful. So saving a little extra money. So if you're going to buy a house that's going to cost you 25,000 in down payment, also consider I'm going to have to pay for closing costs. Don't get overzealous and jump in and think you're going to do this without, again, having some conversations with Jonathan or myself or anybody for that matter that's in the industry to say, hey, think this through. You're going to need this, this, and this. And as far as a credit score we talked about, like just preparing, don't open credit cards, don't run up the lines. These little things go miles. And one last thing about this would be a lot of people tend to think that, oh, I got to squirrel away all my money into one account. Like they'll move it from this, and this, and they put in one account. Don't do that. It just makes your life more difficult because you're going to have to provide us all more documentation showing the movement of the money. The mortgage is very anti-money laundering sensitive. And I know no one's going to be laundering money on this call. At least I hope not.
Yeah.
They're going to look into this type of stuff. And our goal is to make this as simple as possible by having you have to give us as little documents as possible. Again,
that's helpful.
Goes miles in this case.
That's helpful. We've got a lot of questions here. Before I do that, it sounds to me like one of the key takeaways is building a relationship with your lender, building a relationship with the team here, having a conversation early, and really getting prepared in advance of your deal that you're going to do. And so I think that's really great advice. And it's good to know a little bit more about DSCR because there's always all these confusion around DSCR, like what is it? How much money do I need? How does it work? So that's super helpful. So we do have a bunch of questions here just for the audience. Like we won't get into like your personal situation type questions. If the questions are helpful for everybody, we will share that here and try to get you help. But if you have specific scenarios of certain deals you want to chat with, go ahead to baselane.com/loans. There's a calendar invite on the page where you can get time with Jonathan tomorrow or probably Monday, and you can have that detailed discussion. Just to be fair to everybody else,
we're gonna add Ryan to that mix too, for sure.
Yeah, and Ryan as well. Yeah. Sorry, I know one of those calendars goes straight to Jonathan. I'm sorry, my 2-year-old is home, so heads up, she might jump in here at any time. And so one of the questions here, she might be. How do mortgage lenders view W-9 income versus W-2 income? I'm self-employed.
That self-employed is definitely a different animal. Think of it this way. W-2, you get the W-2, the number on the W-2 is the number. You made 100 grand on your W-2, done. Conversation's over. Well, to a degree. Self-employed, you're going to have, it depends on your self-employment structure, right? Are you Schedule C, sole proprietorship? Are you an S Corp, C Corp partnership? They're going to require different returns. We have to look at a 2-year history. Sometimes we only need 1 year. That's not an easy question to answer without knowing the background. But there's more discussions that have to be had. It's not as simple as just taking X that you provide on one document. Like we have to look at deductions that were made, certain things that underwriters will discount and so on. So again, happy to help with that. It's too wide for this conversation, to be perfectly honest with you.
Yeah, so definitely reach out if you're self-employed and share your information, see what's available to you. Next question is, will DSCR loans be reported to the guarantor's credit?
Question. Some do, most do not. And most is really like 95%. And the reason is that they're considered business loans and not personal.
I see.
And it's not going to report a business loan to a personal credit report. So most likelihood, not going to happen.
Is that still the case if you have a personal guarantee on that loan, on the DSCR loan?
Yeah. Okay. And then here's something important to understand: is LLC versus, or like holding it in an entity versus as a natural person, like we talked about earlier. DSCR is different from conventional, that you can actually have the financing put into the LLC's name. So the LLC or the entity is the borrower and the LLC is the owner, which takes all the liability out, not all, that takes a lot of the liability out of the equation, especially when you have renters slip and
Right.
fall, they have to come after you. They have to go through the LLC first to get to you. So I would
Right.
advise
Right.
heavily in thinking about that when we would have these discussions. With conventional loans, you can't close in the LLC's name, to make that clear.
Right.
Okay? Which is a big question that I get all the time. We have to close it in the person's name. The title's in the person's name. After you close, you can do a quick claim deed and transfer the title from the individual to the LLC, but there are due on sale clauses or
Additional costs. Right.
costs too.
Associated.
Yeah. So
Yeah.
Yeah,
that's
it's not just a no-brainer to just transfer it over. So be mindful.
Right.
Yeah. There's a question from Manish. Is Simplist a direct lender? I think that's what he meant. Or do you shop our info for the best lender?
Yeah, so precisely the latter. And I think it's been a big part of our success. We've really put together a very, for lack of a better word, just a cool group of financing partners that we source through. And I think that gives us the competitiveness and the speed. I think, that's, using our technology the right way and porting it to others technology wise has given us a speed advantage. So the latter for sure.
Got it. There are some questions here more about remodeling, like they bought a property and now they need funds for remodeling. Is that more of a construction type or different type of loan? Is that something that you're offering today?
I mean, you can get home equity lines of credit to do that, depending on the amount of equity that's in the property. There are, there's certain loans that are actually in the conforming space. Home style is Fannie Mae's
That's right.
product that I love. And there's also FHA 203K. There's two types. There's streamline, or excuse me, limited, which is max is 30,000 in reno costs, and you can't do anything structural. Past that, use regular 203K. So there are loan options to do that, to do those types of, build out. Say you want to add another story to the house. We can certainly have those discussions as well.
Okay, that's awesome. And is that process just the loan process, applying, getting approved, all that? Is that similar to like a regular loan process,
Yeah, I mean,
or is it?
the only difference that you're going to see there is that look, we would look at it the same as a regular conventional conforming loan. Do you qualify
Okay.
personally? We went over that. The
Okay.
additional work that would have to take place would be you have to introduce us to, or you have to find a contractor. You're going to have to get specs, the blueprints and so on. If you're going to start building out, you have to get permits, etc.
Right.
So
Right.
definitely more work, but you have to go in this transaction knowing that this isn't going to be like a 30-day easy peasy, give me W-2s and we close. You have to put some time in, right? And we're willing to put the time in as well. And we have many of our partners have specific groups that deal directly with the client that are extremely plugged into this world that facilitate these types of transactions. Again, that's why we partner with multiple partners to find those who fit not only the borrower's mold, but the transactions mold as well. And this would be one of those cases where we want to work with someone
That's
that's
helpful.
knowledgeable about construction builds.
Got it. That's super helpful. I'll make this a general question from Anonymous. If you are a co-signer on another type of loan, and now you're trying to get a rental property loan, I think that's what you mean for the question. Does that raise the interest rates that you get on your rental property loan? Seems like a very specific thing, so I don't know the details here, but
That's okay. We could hit it high level.
Yeah, are we talking about that person looking to qualify for a DSCR loan or a conventional?
that I don't know, but I
different
think
use
they're
cases.
saying if they're co-signing on a student
DSCR
loan,
doesn't matter.
yeah,
It would only
DSCR
be
doesn't matter, right? It's not your personal,
Exactly.
right?
Yep.
Okay.
It's all about that coverage ratio.
Okay, so if you're worried about the rates there, you go for the DSCR, not the conventional,
Yeah,
right?
but just understand that it's not the debt to income ratio that drives the rates. There's a very slight adjustment or could happen with the debt ratio, and that could move you in and out of product types. That's it. Don't get hung up on if I'm co-signing on another loan that my rate's going to be higher. That's typically not, it has no effect on anything. What would have an effect there is, can you qualify? Would we have to consider that debt as part of your monthly debt to income ratio calculation? And there are ways to offset that debt that, we know that they're known ways. Like, for an example, if you have a car loan that you co-signed on and you could show me 10 months of history of someone else making that payment, the driver of the car your daughter
Right.
driving that car you're paying
Right.
co-signed for, we can negate that debt from the calculation. So again, these are the little tricks that if you think you're close, don't make any assumptions. Let us tell you you're not close and everything's cool, right?
Yeah, there was a question here from one of the one last question we'll do here. Where can I find the fees you charge for DSCR loans? And I'm not sure that's kind of the right way to think about it in general. If you're leading with the fees of X because you don't even know what the loan size is and all of these other things. I don't know if you guys want to comment on that, but it sounds like you should go to the link and set up some time here with the team to talk more.
Yeah, no, I think that's definitely, I think, the best answer, and it's not just a punchline. It really is going to vary, and we need to kind of understand just some of the basics, right? There are just a baseline level of mechanics that we need to gather for you, and then allow us to do that work for you and give you some some custom numbers. Because at the end of the day, you should never go off of a general quote. You should try to get a detailed breakout.
Yeah, absolutely. And I think what you guys have here is your personal advisors for lending for your rental business. And this team is not going to hassle you. They're super knowledgeable, as you saw, and they've been in the business for decades, as you heard. And really, again, the key takeaways, I keep saying this, but I think we need to keep driving this home, is to start early, prepare, as Ryan said, and have a good relationship with your loan officers. The Simplist team is here and available. And with that conversation, I think what I've heard from people that are using Simplist is they understand what they need to do and they know what the plan is. And then they can be more confident when they go out there and try to buy deals, which I think really all of us should be, because when a good deals come in, you probably have 24 hours to close on it. That's usually what happens. That's my experience. Any last comments or thoughts from Jonathan or Ryan before we wrap up?
I'll just hit the nail that you just put on the wood with my hammer. You have to get pre-approved. It is imperative. If you're even thinking about transacting in this space, don't wait to the last minute. Let's do the homework up front. We'll figure out what you need, what you don't have. Let's get it, whatever. It's that, again, I said it before 5 times. Prepare, prepare, prepare. So if you're even thinking about it, get us involved. We're happy to help.
I would echo that, and just again to reiterate, we like this stuff. We're both pretty lucky. We really like what we do. So, and we're pretty humble. If we don't know the answer, we're gonna find out.
Awesome. Thank you so much. I'm going to just share, as I promised, quickly. So here's if anybody's looking to figure out how much rent you can get for a certain property, this is on baselane.com. Just go here. We'll send you the link in the email as well. Type in a couple of pieces of information, and you're going to get this information right here. This is actually from public MLS data as well. It's powered by a couple of different sources. So you get a pretty good starting point to estimate in your model what the equation looks like. And then if you are unfamiliar, you can go ahead to baselane.com/rental property loans. And here, just go through this process to get started. There's a video that explains how Simplist works. You can watch that video. There's a lot more information about the different type of loans that are available. And again, if you want to schedule time just on your own, you can go ahead and click here, grab 15 minutes with the Simplist team, or once you apply, they will reach out to you. So that's pretty straightforward and simple. And yeah, with that, we're going to wrap it up. So thank you so much for all the people that attended and listened. And thank you to Ryan and Jonathan for being with us and sharing all your insights and knowledge. And we'll get you on the next time, hopefully soon. Thank you so much.
Thanks for having us. Take care.
Take care. Bye. Bye.